What does it actually cost to copy a member of Congress's stock trades? At Ground Truth, we take a money-making strategy somebody is selling you and test whether it actually works. Today, it is copy trading, an app that mirrors those trades into your brokerage account. A reviewer named Kevin put $2,500 of his own money in for 18 months. It made him $608, that is 24.3%. The subscription runs $100 a year, and on $2,500, that is 4%. 4% a year, every year, before the strategy has done anything at all, and 24.3% sounds good. This whole episode turns on why it is not. Now, one piece of vocabulary, because everything after this depends on it. An index is just a big basket of stocks you can buy in one go, without picking anything. The S&P 500 is, as the name says, 500 large American companies. The Nasdaq 100 is the 100 biggest non-financial companies on that same tech-heavy exchange. Buying an index is the lazy option. It costs almost nothing, and it is the thing any paid strategy has to beat in order to be worth paying for. So that is the test, and here is the part that makes this worth an episode. He ran that test himself. He looked up both of those indexes over his own 18 months, and by his own account, the S&P did about 25% and the Nasdaq about 30%. He got 24.3%. Both of them beat him. And he said that out loud, on camera, unprompted, about his own money. His channel is called Financial Tutor, and he is the honest end of this business. Two more things he did that cost him something. He corrected one of his own guesses on camera when the data disagreed with him, and he tells the low-effort viewer to skip all of this and buy an index fund instead. He also named the three costs that decide this: the subscription, how often it trades, and the tax. He did not run any of them. We could only price one. So his honesty is settled, and it is not the question. The question is what those costs come to, and where the number he used instead came from. We have no view on whether members of Congress should trade stocks. We have a view on what this subscription costs you. One more word before we start, and it is the one the whole middle of this episode turns on. The thing you measure a record against has a name. It is called the benchmark, and all it means is whichever index somebody picked to compare that record to. We are going to call it the ruler, because that is the job it does, and here's why the word matters at all. Same portfolio, same dates, different ruler, completely different sounding result, and the person selling you the portfolio is usually the one who picks the ruler. Now, here are the three questions worth keeping. 1. What did the subscription actually cost him? 2. The record that sells this thing. 232% since launch. How much of its lead over the market is the strategy, and how much is the ruler? 3. At what account size does the subscription stop deciding the outcome? This is Ground Truth. Quick note, this is education and entertainment, not advice. We test ideas, we do not tell you what to do with your money. The pitch first, because it is a good one, and it explains why anybody signs up for this at all. And notice what is doing the selling. Nobody subscribes to a mid-cap industrials tracker. The name on the tile is the distribution. You have seen the headlines. Why guess when you can just copy? The app watches the disclosures, and when a trade gets filed, it mirrors that trade straight into your own brokerage, Robinhood, Schwab, whatever you already use. You do not learn a platform. You do not pick a stock. And the flagship? Since it launched in early 2023, 232%, the S&P did 92%. Keep track of who is speaking there, because it matters for the rest of this. That 232% is the company's own number about its own product. It is not his, and it is not ours. We are going to take it at face value and test what it is being compared against. That is genuinely how it works, and we will come back for that 232% before the end. One boundary before the arithmetic. A federal disclosure law requires those trades to be filed publicly, which is the only reason a product like this can exist at all. Whether that law is the right one is somebody else's video. We have one question here, and it is a smaller and meaner one. What does this subscription cost you? At the balance he ran it at, the answer turns out to decide the whole thing. So let us start where the review started, because it used real money. He put $2,500 in and held it for 18 months, and it made him $608. Now add the subscription. He quotes it himself, $100 a year. The arithmetic that decides this episode is the smallest piece of it. On an account of $2,500, $100 a year is 4%. Think of it as a cover charge. The club takes the same money at the door whether you spend $50 inside or $50,000. If your night is big, the cover is nothing. If your night is small, the cover is your night. That is what a flat fee is, and it is rarely said out loud. A flat fee is a percentage in disguise, and the percentage gets worse the smaller you are, which means it lands hardest on exactly the accounts these things are marketed to. 18 months of it, prorated, is $150. Against $608 of gain, that is very nearly a quarter of everything he made. His net comes down to 18.3%. Net means after the fee. It is the closest thing here to a number you can actually spend. Now run the same arithmetic backwards, because this is the number the review never reaches. Forget what he got. Ask what he would have needed. To end up level with an index that did 25, not beat it, tie it, that portfolio had to earn 31% gross. Gross means before the subscription came out. 25 to match the index, plus the 6% of his principal that the subscription took. He earned 24.3. The video describes the difference between his return and the index as the index doing slightly better. Before the subscription, that is fair, he was behind by less than a single point. After the subscription, he is at 18.3 and the index is at 25. That is a gap of nearly 7 points, and 6 of those 7 are the subscription, handed over at the door, about a quarter of everything he earned. And I want to fix one word here, because it is about to do a lot of work, and it means two different things in the sentence I just said. 18.3 is a decimal, 7 points is a gap. The gap kind has a proper name, a percentage point, and it is the distance between two percentages, not a percentage of anything. From here on, every number that ends in points is a gap between two things, and I will say which two. A disclosure while we are here, because it cuts against us and you should have it. We priced one of his 3 costs. We left the tax alone, and the tax runs against the product, not for it. So the number you just saw is the generous version. That was question 1, and it is answered. The subscription cost him about a quarter of his gain, and on his account size, it sets a bar of 4% a year, every year. So, on his own numbers, the thing trailed. And to his credit, he says exactly that on camera, that it did not beat the S&P over his window. What he concludes is that it was worth it anyway. That is a different claim, and the thing carrying it is a number that came from somewhere else entirely. Watch what happens next. It is not specific to this product. A reviewer runs a real experiment with real money. The experiment comes in behind the market, and then the verdict gets rescued by a figure he did not measure and could not independently verify because he got it from the company selling the product. His own clean result is the one number in that video that came from his own account rather than from a marketing page, and it is the one that gets set aside as unrepresentative. Call it the rescuing number. We checked the ruler. And to be clear about what we did not do, we never audited that 232%. We take it at face value, and we are not going to pretend otherwise. What we tested with our own data is what it is being measured against. One check before we argue with anybody. They say the S&P did 92% over that window, so we pulled the real index ourselves, counting dividends. Depending on which month in early 2023 you start, we get anywhere from just under 89% to about 104. Their 92 sits inside that. Their window is fair, and we can go on. But notice what just happened on the way past. We changed nothing except the month we started counting, and our own answer moved by 15 points. The gap between one index started in January, and the same index started in April. Fine, but it still beat the market by a mile. You are not arguing with that. No, we are asking what it should have been compared to. And on this, the reviewer says it himself, these trackers hold far fewer stocks than an index fund, and that concentration is where the bigger swings come from. So it is a concentrated book. That is the industry word for the list of things a portfolio actually holds, and a short one. What else is in that book we have never seen, and we are not going to invent it. Now the part that is ours, and I want to label it before I say it, because it is the weakest thing in this episode. If that book leans the way concentrated books usually lean, then the benchmark that matches it is the technology one. That is a read, not a measurement. It is the one thing here that could flip the rest of this, and we will come back to it at the end. So take that record and put it beside the broad index, on our own numbers. It finishes 128 percentage points ahead, and there is the gap kind again, the distance between the tracker and the index. Now change nothing except the ruler. Put that same record beside the Nasdaq 100, the technology benchmark, and the one that matches only if that read of ours is right. The same record now finishes 48 points ahead. Same portfolio, same dates. The only thing that changed is the ruler, and 62% of that 128-point lead went with it, not the strategy, the ruler. And that matters to you for exactly one reason. That record is the only evidence anybody hands you at the moment you decide whether to pay. For his own 18 months, the review checks both indexes, including the right one. The platform's record arrives from the marketing page already paired with the S&P, and it goes through as it came. So the ruler that matches the portfolio is in the video, just not in the comparison that sells the product. That start date effect is worth one more minute, because on the technology index it is much bigger. Here is the measurement. Same index, same finish line, and the only thing we change is the month we begin. Inside the 4 months anybody would call early 2023, the best starting month finishes just under 50 points above the worst. Now, both of those numbers end in points, so let me say what each one is a gap between. The 128 points measured the gap between the tracker and the broad index. That just under 50 measures a gap between one index and itself, begun a few weeks apart. Different pairs, different distances, which is why the two do not stack. And the tracker's launch window is the best of those 4 months. We are not saying anybody chose that. They launched when they launched. So we will make the narrower argument, and it is enough. If a start date is worth that much, the start date is doing real work, and that record is quoted from a single start date, the best one in the window. So that is question 2, and it is answered. Most of the lead that record shows over the broad index is the ruler somebody picked, not the picking. 2 down. Here is where we are. The fee is settled. You can work it out on your own account in 5 seconds. The advertised record is now worth a lot less than it looked. And there is one thing left that the record cannot tell you, no matter which ruler you use, which is whether anybody on that platform is actually any good at this. So what does the $100 actually buy? Here is what he says it buys. 29 portfolios on that tier, and anything built by an outside creator is a separate subscription stacked on top. The record that sells the whole platform comes from exactly one of those 29. Now, here are the 3 questions worth keeping. 1. What did the subscription actually cost him? 2. The record that sells this thing, 232% since launch. How much of its lead over the market is the strategy, and how much is the ruler? 3. At what account size does the subscription stop deciding the outcome? 1 is answered. 2 we can measure, against their 232%, which we still have not audited, and against our own S&P. Of the 128 points that record sits ahead of the broad index, 62% was the ruler. This last test asks something different. It does not ask what is left over. It asks whether a record like that one is remarkable at all once you know how many portfolios were on the menu. The review's own biggest lesson is this. You are not really buying the platform. You are buying whichever portfolio you pick. And that is completely right. He goes further than that, too. He says that if he were starting again, he would spend more time picking the portfolio that fits his goals and his risk tolerance, because that is the biggest factor in the result. Coming from a reviewer, that is ordinary, sensible advice. Then do your research. Pick the portfolio that fits your goals, your risk tolerance, your style. That is the whole skill. Now hear that same sentence coming from whoever is selling the menu. Call that the menu defense. From him, it is prudence. Deployed as a defense, it cannot lose. Here is why it cannot lose. Every portfolio that wins is the platform's proof. Every portfolio that loses is your selection error. There is no result the product can produce that counts against it. And there is a second problem with it. Telling you to pick the one that will do well is not risk management. It is asking you to identify the future winner, which is the exact thing the subscription was supposed to do for you. Start smaller. Put 29 people in a room and have each of them flip a coin 10 times. Somebody will get 8 heads or better. That is not a gifted flipper. That is what 29 tries buys you 4 times in 5. Now make each coin a portfolio, and make the whole run 3.5 years long. That is a Monte Carlo. We build the world on a computer and run that world 10,000 separate times, so the answer is what usually happens, not what happened once, and we set it to 0 skill. Statisticians call that a null. Nobody knows anything. Every portfolio just drifts around the index at random. A simulation? Come on. That is not real money. That is not a real track record. No, it is not. It is the question you have to answer before a real track record means anything. How often does a number that good turn up when nobody is doing anything clever at all? One dial runs the whole thing. How far a portfolio wanders from the index in a year, that has a name too. It is called tracking error. You can feel the range of it. A broad fund barely moves off the index. A handful of big technology names moves much further. And here is what the machine says. Once you set that dial to 11 or 12% a year, depending on how much those portfolios move together, a winner as good as the advertised one turns up by chance alone. Push the dial higher still to somewhere between 15 and 27%, and a winner that good is not merely possible, it becomes the expected outcome. Now be careful with what that does and does not prove. We are going to be careful too. 11% is not a measurement of this tracker. We have never seen its holdings, and we wrote down that we would not assume them and fixed it in the record before we ran a single trial. That practice has a name. It is called pre-registration. So, what is 11%? It is the level at which the advertised record stops being evidence of anything. Where this tracker actually sits, we do not know, and that is the number that would settle this. And it can cut against us. If this thing turns out to be genuinely spread out, a full point or more under that line, down around 10%, this argument gets much weaker, and we will say so. This does not show there is no skill here. We did not test that. What it shows is that this evidence cannot tell the difference. Take a menu of 29 portfolios. If they are concentrated the way a technology book is, that menu produces a spectacular winner whether anybody is good at this or not, and the winner is what goes in the advertisement. When you pick a portfolio off that menu, you are not picking a strategy. You are picking a row in a table somebody else already sorted by the one column that flatters it. So, both of the things we named have now done their work. The rescuing number is what a verdict leans on when the experiment underneath it points the other way, and we have shown that most of the lead it shows over the broad index is a ruler, not a strategy. The menu defense is the argument, the platform's, not his, that a bad result is your fault for picking wrong, and we have shown that a menu that size produces a winner all on its own. That leaves the only question that was ever actually yours. Question 3. At what account size does the subscription stop deciding the outcome? But first, we owe you our own scorecard. We pre-registered this whole thing, not just that one refusal. Every guess we had, written down and fixed in the record before we ran a single number. We have not touched that order since. If we ever publish this lab, you will be able to check that for yourself. And it is the only reason the next sentence is worth anything. A scorecard you are allowed to edit afterwards is not a scorecard. 8 guesses. 6 came in. 1 came in off. We thought the menu effect would be harder to produce by luck than it turned out to be. And 1 cannot be scored at all for 2 reasons, and both of them are ours. We wrote the guess with an escape hatch in it, a clause so open-ended that almost any answer would have satisfied it. And we wrote it against the company's own comparison, which we later ruled invalid because it mixes their numbers with ours. So the guess had an escape hatch, and it was aimed at a yardstick we ourselves threw out. It is unscorable, and that is our error, not a near miss. And where we were off in the same direction. The product looked worse than we had predicted. When your surprises all flatter your own argument, that is exactly when you should not trust yourself. So we are telling you out loud that our errors ran one way. So, is it worth it? That question needs 2 stamps, and we can only ink one of them for you. The first stamp is the fee, and it is settled. You can check it yourself in about 5 seconds. Divide the subscription by your balance. That number is your bar. It is the outperformance the portfolio has to deliver just to break even against a plain index fund. On $2,500, $100 a year makes that bar 4% in year 1. Now make the account 10 times bigger. On $25,000, the same subscription is 0.4%, and that is an ordinary number. On $100,000, it is noise. So, the whole thing is fine then. You just spent 10 minutes getting to nothing. At that balance, the fee stops mattering. That is the whole finding, and it is why the answer has a size attached to it rather than a verdict. Here is the scale to hold it against. An index fund charges what the industry calls an expense ratio, a slice of your money every year instead of a flat bill. The cheapest of them take 0.03%. In plain money, that is 3 cents a year on every $100 you have with them. That is the industry's published figure, not ours. And here is the balance, which is ours. A subscription of $100 a year only gets that cheap once your account reaches $333,000. The second stamp is whether the strategy has any real edge, and we are not going to pretend we answered it. We did not test it. What we can tell you is that the advertised record cannot settle it for you either. Most of its apparent lead over the broad index is the benchmark somebody picked, not the picking. And here is a second lens on that record, not a further slice off the lead we just measured. Take the gap exactly as the advertisement states it, their number against their index. A menu of 29 portfolios produces a gap that size by luck alone once those portfolios wander 11% a year. Whether these portfolios wander that far, we do not know. That is the point. The record cannot tell us. One more thing our model does not price, and it runs in the product's favor. Somebody who would otherwise pick stocks badly, or never invest at all, may do better inside a rules-based tracker than outside one. We priced costs and selection. We did not price that. So here's the honest answer, and it is a condition, not a thumbs down. Try it if your balance makes that fee a rounding error, and if you believe in the edge for some reason other than the number in the advertisement. Do not try it if you are funding it with a couple of $1,000s. At that size, the subscription decides the outcome before the strategy ever gets a vote. And that is question 3, answered. Somewhere around $25,000, the subscription stops being the term that decides it. Which is the boring finding underneath all of this. It was never the price. It was the price divided by the money behind it, and the reviewer ran his experiment at exactly the balance where that division hurts most. Take one thing away from this. The next time anything financial is sold to you for a flat price, a subscription, a platform fee, an advisor's minimum, divide that price by the money you are actually going to put in. That is the cover charge. Under 0.5%, you can ignore it. Over 1%, think hard. Over 2%, the fee is running the show. On $2,500, $100 a year is 4%. On a $100,000 account, the same $100 is not 4%. It is 1/10 of 1%. Same bill, same door. 2 completely different nights. 2 things would change our mind, and both are live bets. The first is the one we flagged in the middle of this, and I said we would come back to it. If that portfolio is broadly diversified rather than concentrated, the luck explanation loses most of its force. The second is a thing we have not touched at all today. The filings print 2 dates, the day a trade happened, and the day it was disclosed. This product can only ever act on the second one. So whether anything a copier can actually buy at that second date beats a technology index is the test that would settle this. We have not run it. When we do, we will publish it whichever way it lands. One structural fact about this genre, and it is not about any one person. In review videos, the recommendation is spoken and the product link is written, and the disclosure that goes with the link is written too. That asymmetry is how the business is built, including here. And we think the reviewer believes what he concluded. The rescuing number does not need anybody's bad faith. It is a trick the number plays on everybody, because the vendor's figure is bigger and cleaner than anything you can measure in 18 months on a small account. We have reached for numbers like that ourselves. So, credit where it is owed. He spent his own money, he reported that both indexes beat him when he did not have to, he corrected his own guess on camera, he named the 3 costs that decide this, and he tells the low-effort viewer to buy an index fund instead. His video is linked below. This is ground truth. The machine is always hungry.